Right now, you can buy an apartment building at around a 5% cap rate. An industrial warehouse, mid-6 cap. Open air shopping centers, 7, 8 cap. Enclosed mall, 9, 10, 12, even 15 cap rate. That's not a small difference. That's 2 to 4 to 600 basis points spread inside the same broad category of real estate. And when pricing diverges that much, it's usually telling you something's broken. But what if it's not? If you put all major commercial real estate asset classes on one chart, something strange happens. Apartments, industrial, open air retail, they all sit in a relatively tight band. They move with interest rates. They move with capital flows. They behave like normal institutional assets. And then there are enclosed malls, just sitting out there, detached from the rest of the market. In real estate, that kind of dislocation is rare because capital is usually very efficient. Money flows to where risk-adjusted returns make sense, and over time, spreads compress. But this spread hasn't. And that's what makes it interesting. Now, the obvious explanation is malls deserve it. E-commerce, Amazon, department store bankruptcies, the retail apocalypse. And to be clear, those were real forces. From roughly 2015 to 2020, the mall sector went through a brutal correction. Anchor tenants disappeared, in-light tenants struggled, foot traffic declined, and capex increased. A lot of assets simply didn't survive. So yes, the sector earned its bad reputation. But here's the problem. Markets don't price history, they price the future. And the question is, are malls today the same assets people think they are? Something important happened during that collapse. The worst malls got eliminated, not gradually, but violently. They were sold at discounts, repurposed, redeveloped into mixed use, or simply written off entirely. What's left today is not the same universe. It's smaller, more curated, more concentrated in better locations. At the same time, retail fundamentals quietly stabilized. Vacancy across retail dropped to near historic lows. New construction slowed dramatically. Tenants started competing for space again. In other words, retail didn't disappear. It reset into a tighter, more supply-constrained system. And capital noticed. But it didn't come back evenly. It came back selectively. Investors piled into grocery-anchored centers, necessity-based retail, open-air strip centers. Assets that were simple, predictable, easy to explain to investment committees. Those sectors re-rated quickly. Cap rates compressed, competition increased, pricing normalized. But enclosed malls, they were left behind. And this is the part most people miss. Real estate pricing is not just about income, it's about who is willing to show up and bid. Over the last decade, a huge portion of institutional capital just stopped looking at enclosed malls. Not always formally, not always explicitly, but functionally. They moved on. And when that happens, you don't just lose demand, you lose price discovery, you lose competition, you lose liquidity. Because real estate is priced at the margin. If 20 buyers show up to an auction, pricing gets tight. If 3 buyers show up, pricing gets wide. Now, apply that to an entire asset class. Enclosed malls don't just have risk. They have fewer natural buyers. And fewer buyers means higher cap rates, lower valuations, wider spreads, even if the underlying fundamentals have improved. Let's walk through some math. Say a mall produces $10 million in NOI. At a 12% cap rate, that's worth about $83 million. Now, assuming nothing changes operationally, same tenants, same rent, same NOI, but sentiment improves just slightly. Cap rates compress to 10%. That same asset is now worth $100 million. That's a 20% increase in value with zero operational improvement. Now let's say you add real execution. You replace weaker tenants. You redevelop an anchor box. You improve foot traffic. You increase sales, productivity, and NOI grows from 10 million to maybe 11 million. At a 10% cap rate, you're now at $110 million of value. That's over a 30% increase in value. Same asset, same location, different perception. This pattern shows up again and again in real estate, not because markets are irrational, but because capital moves in waves. First, capital overreacts to risk. Then it avoids the entire category, and then slowly it starts to come back. But it never comes back all at once. It starts with the safest version of the asset, then gradually moves outward. And that's exactly what happened in retail. Open-air centers re-rated first. Enclosed malls haven't fully yet. So it actually causes the spread to close. It's not one big moment. It's a series of small shifts. Better tenant mix, stronger sales per square foot, successful redevelopments, lender confidence returning, and most importantly, more buyers showing up. Because the moment more capital starts competing, prices move fast. So the opportunity isn't malls are misunderstood and everything's great. That's not the bet. The bet is simpler than that. The narrative overshot reality. The weakest assets are already gone, and the capital markets haven't fully caught up yet. Because when an entire class of investors stops looking at something, pricing gets distorted. Competition disappears, spreads widen far beyond where fundamentals alone would justify. The anomaly isn't that malls are risky. The anomaly is how wide the spread still is.